Welcome everyone to the Kendall Report, where I share my 44 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In tonight's video, I'm going to discuss the FOMC meeting that occurred today. I'll talk about what I believe the Fed will do going forward, what the impact of today's meeting will be. Let's get into this. Just to get into tonight's video, I believe the markets are misinterpreting what is this growing confidence that rate cuts are going to happen. I still am arguing that this is not the case. In fact, we're going to play a couple clips of Jay Powell talking, and I believe that while the markets are pricing in 150 basis points over the next year, maybe that's the case, but I don't see it starting until we get into maybe around December, and I'm still sticking with first quarter of 2025. There's a couple of things that Powell said today that I think are interesting, in that there's no need to do anything. And I told you folks that last night in the Substack, is that there's no need for them to change anything. There's no pending emergency. The markets aren't plummeting. We're not seeing any type of big increase in unemployment. But I think ultimately what we're going to see is what I've been talking about for a while. So what did Powell say today? Really nothing. Okay, he said the same thing he's been saying over and over again. And I keep telling you folks that the Fed is going to stay very rock solid on this inflation situation. You also know that I have been talking about inflation bouncing as we come into September and October. The problem is, we'll be beyond that September meeting, but like I always argue, the Fed already knows what the employment numbers are on Friday. Trust me. Maybe they come in a little bit hotter than expected. Every metric around labor still continues to be good. In fact, the continuing claims and the claims, like weekly claims, if we were in a recession, would be pushing somewhere around 300 to 350,000 claims. We're nowhere near that. We're 2.25 roughly almost every week. It fluctuates very little. So it's really this fears of a recession are way overblown. I see folks talking about it all the time. I don't see it happening. The anecdotal evidence and the job losses does not reflect overall conditions of the markets right now. And we're just seeing the whole action around labor, and I just don't see that changing. Now, I have been talking going back several months ago. I thought we would go to 4.2% as we come into Friday. I believe that will be a possibility. We're at 4.1. I still think there's a slight uptick. Don't think we get to 4.5. That's actually a bigger number than you think. Now, remember, they keep mentioning this immigration, strong immigration. He said those words again today. And that is nothing more than we're actually seeing this illegal immigration, whatever you want to call it, continues to pack the books. The other thing that's happened was interesting is that the government hiring, if we go back 6 months ago, was flat. All of a sudden, they're cooking the books. They're hiring more people in the government. So the government hires are also keeping the employment rates going in a positive way. So maybe the economy is not that strong. There certainly are a bunch of soft spots around, but we're not really seeing any material change. And if the Fed's based on the data, as they keep telling us, then that's the case. Listen to a clip from Powell, and I'll come back on and we'll discuss a few more things.
But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case. are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really a statistical regularity, is what I'd call it. It's not like an economic rule where it's telling you something must happen. So, again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So, again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market, and we're watching carefully to see if it turns out to be more. If it starts to show signs that it's more than that, then we're well positioned to respond. History doesn't repeat itself; it rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be: is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of, admittedly, very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen.
Well, folks, after watching that clip and going through some analysis, the chart that I'm going to show you in a minute, I've shown you before. It's basically the front end of the rate or the Fed funds, and I'm applying the algos to it to predict in the future. And in the past times that I've looked at it, we were looking at potentially November and then the first quarter, which is what I'm saying. Just looked at it just now to update it, so I'll contradict a little bit of what I said earlier, but the possibilities are growing that we could move in a little bit earlier, maybe November and December. The forecast I'm going to show you, looking at the screen here, is it's showing that we're going to move down a number of levels here. And just to give you an idea, we're looking at a move possibly in September would be based on this forecast, and then a move down in November, and then another one in December, probably 25 basis points each time. Interesting, because as I look at that, my analysis still is that we're not going to see some sort of recession going to be driving this. I don't think that's going to be the backdrop, although it's going to be played out maybe that way. I've been talking for a while about this scenario where we're looking at the yield curve. I'll bring in a chart here in a minute on the yield curve, and it is actually suggesting that we're going to see an opposite of the inversion, where we're seeing a steepening of the yield curve. A quick note on this: if you notice, Powell said that one of the things that is not solid in stone, what was his comment? That history doesn't repeat itself, it rhymes. And that is exactly what I've been telling you for a while, is the reason why the inverted yield curve did not mean recession is because of the dynamics of the markets and how the Fed moved to raise the rates up on the front end of the curve. They moved the rates up sharply to fight inflation. In the past, when we had inverted, there were different things that were driving those market events, such as tightening of money, different types of things. When you get that type of inverted yield curve, then you see that the inversion then means recession. Because typically, if money is very high on the front end of the curve, that means there's a high demand for short-term money, and that's usually a sign of that tightness, and it squeezes the economy. This is not the case. We saw the economy rolling fine, and what we did see is the mortgage rates come up, up into the 6 to 7+% range, and that is actually what's driving the markets from the standpoint of the back end of the curve. And we've seen some adjustment in real estate, but overall, we've just seen a flattening. We could do a whole video just on the real estate scenario, because that has a lot to do with supply as much as the cost of the money. So as we go forward, then, my expectation will be that the Fed will look to I'm actually going with a 50-50 in September. November is probably 100% for 25, and December maybe 25 now, and it could move over a little bit depending on whether or not we get that bounce in inflation that I have been telling you about. So we'll dig more into that in future videos, but for right now, I believe the markets are going to respond very favorably. Overnight, we're seeing a further bid in the S&P and the NASDAQ, so we're seeing some follow through, and ultimately, it's possible that this Russell trade that's been going on, this rotation, will continue. I do see some potential issues going down the road, but this should be the way things play out. My final analysis of what happened today was nothing. Did they set up for the September? A lot of folks believe so. I think it's more like November. I think they'll stay out of any possibility of a political type situation. So we'll go for November, December potential moves. I've been hanging around December anyway. Maybe move that up to the November meeting. From there, we're going to see a lot of changes in the front end of the yield curve, and ultimately we'll see where the yield curve is steepening. The back end of the curve isn't going to move much, especially 1030s are going to stay around that 375, 4.25 range. On the front end of the curve, we're likely to see come down to the maybe 3%, 3.25, and then back end around 4. We'll start to get a normal steepening of the curve, which is about 150 basis points off the front end of the curve. This will do tonight's video. Thank you so much for watching. Make sure you subscribe to my Substack to get my daily micro analysis. We look forward to talking to you. I've got some very interesting videos coming up in the next couple of weeks. Thanks again, folks.